Last QUAC and Fintech meeting of the year. Thanks for everyone who came to other meetings throughout the year. Let's get started.
So here is the schedule, or I guess our past schedule now. Like Michaela said, this is our last meeting of the quarter. Here are some of the past meetings that we've had for QUAC. So if you want to see the recordings of these meetings, you can just check out our YouTube channel, which will be posted in the chat.
Yeah, so if any of you guys are just starting your internship search, we actually have a career peer advisor here from the Career Readiness, Miriam Abdo, to speak a little bit about what they offer.
Awesome. Thank you so much, Adrian. Can I go ahead and share my screen? Is that?
Yeah, wait, let me give you. Okay, you should be able to now.
Perfect. Awesome. Just a quick little presentation. It's like 2 slides. So again, as Adrian mentioned, I am a career peer advisor in the Career Readiness Center. So for those of you who don't know who we are, our mission is to empower Orfalea College of Business students to develop their career readiness skills they need to succeed in college and their careers by providing them opportunities to build meaningful connections and engage in immersive experiences. So basically what that means is we help students with all of their career related questions. So whether that's resumes, cover letters, interview prep, we also do mock interviews in our office, LinkedIn and networking, job and internship search, salary negotiations, and a lot more. So anything that has to do with really career readiness is what we help students with. We also host concentration panels. So we would love to work with both QUAC and Fintech on those, especially for quantitative analysis, so that more students can learn about the different opportunities and student experiences within the different concentrations. We also hold alumni and employer panels, so different topics. We just had a panel last week about how to thrive in a virtual work environment. So different events based on students' needs. So we, in person, hopefully we will be open, but we're located on the 3rd floor in the Biz Lab. That's our email, OCOP Careers. Feel free to email us with any questions. And then you can scan that QR code to make an appointment. We have drop-in hours. I believe we still have drop-in hours next week as well, but don't quote me on that. But our drop-in hours should stay the same come fall as well. So if any of your club members are interested or need some more career development assistance, feel free to refer them to our office as a resource. Thanks so much, everyone.
Well, thank you, Miriam.
And then hopefully all of you guys know this, but if you are a sophomore or a transfer, the deadline to declare your concentration is going to be May 31st. This is coming up really soon. If you don't meet the deadline, you do get a hold on your account. So make sure you keep an eye out for that and get it in soon.
And as always, feel free to contact us. You can reach out to us in 2 ways, whether that's Instagram or Gmail. Our Instagram is at Cal Poly QUAC. Our Gmail, you can email us at kpquac@gmail.com. And if you scan the mailing list here on the right, or look in the Zoom chat right there for the link, it'll bring you to our mailing list, which will just keep you updated on any events, speakers, workshops, or informational sessions we'll have in the near future.
And if you have any questions about our Fintech Club, we are a club that focuses on educating students about financial technology and the innovation in that market and field. And so if you have any questions, please follow us on Cal Poly Fintech, as well as our membership forum if you'd like. And then we do also have a Slack channel. And if you would like to be added to that, just reach out to me in this chat and I could go ahead and add you to that. But thank you so much.
Cool. So starting off with our personal finance section of this, I'm going to be talking about credit cards and debit cards a little bit, but mostly focusing on credit cards because credit cards are a huge way to build personal wealth. So the first sentence is, the first bullet point is pretty important distinction between debit and credit. So debit is how much you owe, credit is how much you can borrow. Credit is a line of credit given to you based off of your credit score, essentially. And I'll get into credit scores a little bit later. A couple advantages of using a credit card, obviously to build that credit history, um, to offer greater ability for future loans, to have protection from fraud. So if someone steals your credit card and makes a transaction, you can quickly go back and find that and sort of remove that transaction. So it's pretty safe. There's a lot of protection and a lot of warranty for different purchases that you didn't make. And there's also rewards on the purchases that you make. So there are certain cards on the picture on the right that offer like miles or cash back. I don't know if you guys seen, you guys have probably seen a ton of commercials for that. Those are a little more beneficial, especially for bigger spenders who can gain a significant amount of miles and points from their different purchases. So going more to like credit scores, the average the credit scores range between 300 and 850. The average credit score in the US is 711. But to give you guys a little more estimate of what we would expect at like our age, the average credit score for a 21-year-old is 670. So just to give you guys a little bit of a range to think about. And the reason ours is a little lower, a big part of credit score is the length of your credit history. So actually having like years that you've paid back your bills, paid back your mortgage, whatever expenses you have, being able to buy things and then pay them off in time. The bank will see that, or the card companies will see that, and they'll build more trust with you. So that's more of an over time thing, which is why 30, 40, 50-year-olds have better credit, assuming that they are responsible with their money. Other parts of your credit score are based off of your payment history. So like I was saying, your ability to pay it on time, and then the amount you owe. So make sure you don't have any like outstanding loans if you want to build good credit. The different ways to build good credit are pretty simple. Pay your balance on time, pay the statement balance. One thing I do want to point out is I've kind of been lured by a lot of, by like my credit card company to pay the minimum balance. If you guys have ever seen that while you're paying your credit cards, definitely pay the statement balance. If you pay the minimum, it'll like accrue interest. So pay the amount in full. And then try to add, I don't know if your parents have told you, my dad always used to tell me like, pay as much as you can on your credit card and like add up those bills over time to really show that you're using it well and then paying it back. And then the last thing I wanted to talk about is if you don't qualify for a credit card, there are still ways that you can build credit. So for those of you who are still, financially dependent and still want to build good credit while you're in that dependent state, because I think a lot of us, maybe that haven't worked or haven't had that opportunity. You can get a secured credit card, which basically requires you to pay money up front as collateral if you can't pay back your bills. So it's a little safer for the bank. So they'll always be willing to offer you a secured credit card. Another thing is you can become an authorized user, which is like you kind of hitch on an existing account, which is like you could do this with your parents. You could get a credit card through your parents' account, and through paying those bills, you increase your credit score, your own personal credit score. So that's actually a good way before you can even get a card to actually start building up your score. That's it for me with credit cards.
All right, cool. So now we'll talk about stocks, on what stocks are. So some of this might be review if you guys have taken Biz 342 or corporate finance, but still nonetheless, I think it is good to reiterate some of the stuff on here. So the first thing off is, what are stocks? So stocks are essentially just ownership of a corporation, and each piece of this ownership is called a share. These stocks or shares are used to trade, or you can trade them with other people or other institutions that are also buying and selling these shares. So where these shares are exchanged is called the stock market, and then the stock market is kind of like the broad term for the exchange of the shares. And then there's also specific exchanges or institutions that facilitate the transaction of these shares. So a couple that you might have heard already is NASDAQ and NYSE. NASDAQ stands for the National Association of Securities dealers automated quotations. You don't need to know all that, but it is a institution that helps facilitate and helps the transactions between a buyer and a seller of certain shares of a company. And then NYSE is called the New York Stock Exchange. And both of these are located in New York on Wall Street, as you can see from the bottom right picture. And then typically in the past, it was brokers on the trading floor, like taking calls from people that want to invest. But now with the onset of technology and the internet, it makes it a lot easier to buy and sell shares of a company. And then the last exchange that I want to touch on is the OTC exchange, or called over the counter. So the companies that are listed on this stock exchange are typically smaller companies that don't really need to undergo the same checks and certifications that other companies listed on the first two would need to. So that means that most of the companies listed on the OTC are typically cheaper and what are called penny stocks. But some of these companies could be frauds and just be having a front. And then it could actually just be total, like, not worth anything. So people could be buying into these companies that are complete frauds. So you need to be a little bit careful when you're investing in the OTC market. But for the most part, NASDAQ and NYSE is where you're going to find those big companies that you've heard of, such as Apple, Netflix, and Google. And then companies are listed on one or the other, so you can't find a company that's listed both on the NASDAQ or the NYSE. So on these exchanges, like I said, you can buy and sell shares. And of course, like any transaction, if you want to buy something, there has to be a seller. And if you want to sell something, there has to be a buyer at that same price. So in order to buy and sell shares, you can look to online brokerages, which is the most popular form of trading shares. So some of the brokerages that you might have heard of are E-Trade, Robinhood, TD Ameritrade, and Fidelity. Robinhood's probably the most popular one that's been talked about recently. It's very user-friendly, at least for the newer generation. But I know that E-Trade and TD Ameritrade, they have better security over your money and offer you a better price when buying and selling shares. And their transactions typically happen a lot faster than Robinhood does. There used to be commissions for each trade, but since now everything's done online and essentially has no cost to it, most of the trading has been commission free as of like a few years ago. So then I'll touch a little bit on determining stock price and kind of how that happens over time. So one thing that determines the stock price is shares outstanding. So this is like a simple like supply and demand theory. So if there's a limited supply of shares and people are demanding a stock for a company, then that stock price goes up. And then if there is a lot of shares in the market and not a lot of people want to buy shares of that company, then the stock price typically goes lower. And then shares outstanding is essentially just how many shares a company wants to have out in the market. So you can multiply the shares outstanding by the stock price of the company to get the market cap for that company. So if you go on Yahoo Finance or any other finance website where you can look at a stock price for a company, you'll typically see the term market cap and then like some number. It's typically in the millions or billions. So in order to get that market cap, what you do is you multiply the shares outstanding by the stock price of that company. And then another way a stock price is determined is by the company's finances. So I'm sure most of you have taken an accounting class. So this is like their balance sheet, income statement, statement of cash flows, statement of retained earnings. So if the company typically has a good growth year over year, then the stock price goes up. And then if the company is losing money, the stock price typically goes down because people expect that company to either go bankrupt or have their income reduced over time. And then the finances can also give insight into how the company manages its assets. So if a company manages their assets well, then people will invest in it, making the stock price go up. And then if they don't manage well, then the stock price goes down. And lastly, current events also affect a stock price. So more recently, the tanker that was stuck in the Suez Canal, because so many shipments were delayed, that that kind of sent the market downwards because people realized that these companies weren't getting inventory and therefore not selling as much as they could if that tanker hadn't gotten stuck in the Suez Canal. So stuff like that, and just making sure you're up to date with the news and current events of any company or just the market in general is a good way to predict where a stock price might go. And Conan will now talk a little bit about choosing your investments.
All right, so now that you know what a stock is, you may be wondering, how do you choose the correct ones? So before we kind of get into that, I'm just gonna give some general advice for picking stocks and just investing in the stock market. So first off, you should be willing to invest. You should invest only what you're willing to lose, and you should do that because like stock prices are kind of volatile. So there's a good chance that you might lose all the money that you've actually put into the stock market. So yeah, just make sure that you're okay with that happening. And some other things are try and invest for the long term rather than the short term. And one reason that you want to do this is because you actually get taxed less and when you sell a stock after a year than when you sell a stock within a year. So that's one reason. And then also it's a little less active than day trading. So as a beginner, you may not be as familiar and you might not be able to do like day trading and stuff like that. So it's probably a little better off for you. And one other thing you want to do is diversify your investments. So what this means is kind of like not investing in only one company or in only one industry. So like for an example, like let's say I put like all my money into Apple, but then like Apple goes bankrupt. Now I pretty much just lost like my whole investment because the Apple like stock price just tanked. And like similarly, like if I put all my money into like the agricultural industry, and let's say there's like a blight or a drought and like all like the crops die, then all the stocks in that whole industry go down. So what you want to do is kind of like spread your investments amongst industries and amongst companies. That way, if something happens to a company or even an industry, it'll only affect like a part of your total investment rather than like a large chunk of it. All right, so one thing you can do to kind of like look at the numbers of like companies and kind of like determine whether a stock is good or not is called fundamental analysis. And to see how good a company is doing, you can look at their financial statement. And financial statement has the balance sheet, which shows you assets, liabilities, and stockholders' equity. And if that sounds familiar, I think you should have learned about it in financial accounting. So you kind of already know how to read and interpret one of these. So there's two types of financial statements. There's the 10Q and the 10K. And the 10Q is a quarterly financial statement, and the 10K is an annual financial statement. And one other document in the financial statement that you can look at is the statement of cash flows. And that tells you how a company, I think, gets and spends their money. And that's pretty good because if you see like a company like spending cash in their balance sheet, you can kind of see where they're spending their cash in the statement of cash flows. And another thing you want to look at when you're looking at a company is the future endeavors of that company. So that's kind of like their future plans. And you can usually find this information in the financial statement. There should be like a couple pages about what the company did in the past quarter or year and what they plan to do in the future. So it's good to read that and see if like their plans, like you think their plans will pan out and make money for the company or not. And one other thing you can look at is the management of the company. So this is kind of like just look at who's running the company, like the CEO or something. And what you can do for that is look at the CEO's like track record, look at their previous jobs and see how well they performed. And if you think they're competent enough to like kind of like do a good job, then you should invest in that stock or that company. So one thing I want to talk about are ETFs. And basically what an ETF is, it's like a bundle of a bunch of stocks. And this is pretty good because like I mentioned earlier, you kind of want to diversify your investments. So an ETF is just a bunch of stocks, and that kind of automatically provides diversification. So there's two types of ETFs. There's the passive ETFs and the actively managed ETFs. So an actively managed ETF is like an ETF that's managed by a portfolio manager. And what this means is that like they look at all the stocks inside the bundle, and they kind of like, if one stock is doing bad, they'll like swap it out with like other stocks and things like that. And because someone is managing it, you tend to make more money on an actively managed ETF. But one like downside is that they're more expensive because you have to hire someone to actually like manage like the ETF. So I'm just going to go over some examples of some ETFs. So SPY is one example, and that's the oldest ETF, and that tracks the S&P 500, which are the largest companies on the stock market. So it's a bundle of those companies. And another one is the QQQ, which is an ETF that tracks the NASDAQ 100, which is who talked about earlier. And the NASDAQ 100 is 100 of the most traded companies on the stock market. So if you look at the graph on the right, you can see that those are the two, like the black one is NASDAQ and the red one is the SPY, or sorry, the black one is QQQ and NASDAQ, yeah. And as you can see, NASDAQ tends to make a little bit more money. And then from what I understand, the reason it does that is because it's has more tech companies inside it, and tech companies tend to be worth more money. So that's like a plus side of investing in the QQQ. But then I guess one like kind of downside of that is that since it's more tech heavy and tech dependent, if something happens to the tech industry, the price of the QQQ would drop more than SPY. So yeah, just things to be aware of.
Right. So far we talked about credit and debit cards, and then we also talked about stocks. And so how do you approach trying to manage all of that on top of being a college student? So one option that you have is to choose an app that might help you with that. Like Robinhood, for most people who invest in stocks, it makes it easier for them to do all of that. And so in order to have something that helps you out on your daily, in your daily life, to kind of spend your money, but also not go over your spending, an app can be very helpful. And so when you're choosing a budgeting app, you want to look for 4 key features. And those 4 key features are fees, the features of the app, the security, and also the customer service. And so fees can be really tempting to stray away from, because most of us want to have a free app, but it might be very worth it for you to invest in an app that has those features for you, that you can better manage your money. And so it might be worth the investment. And then 2, the features, choosing an app. You need to choose an app that serves your needs the best. And so some of those features that you might want to consider are connecting all of your financial accounts, receiving notifications about upcoming bill payments, designing a budget, credit score tracking, which is also very important as we are going into adulthood. You want to make sure that you have a good credit score in order to get loans, get a car, or something like that. And also setting up financial goals. So later on, we'll be talking about retirement. That could be a financial goal of yours, or if you want to go on a trip, then that's also another financial goal. And so for apps that I found that might be helpful for all of you, one for monitoring daily activity. So if you're like me, I am guilty of spending a lot of money out eating food. And I'm sure that we're all guilty of that as well. And so if I want to monitor all of that activity, I would choose an app called Mint. And if you want to achieve financial goals, so this summer I want to go to Colorado to see my family, then I would want to choose YNAB, or I hope that's how you say it, to achieve that financial goal of getting the ticket, hotel, spending money there, eating food also, all the way up in Colorado. If you want to check your spending, Pocket Guard's also a good one. And then for getting started with investing, there is an app called Stash. And so if you're thinking about going into stocks, and Kanan kind of went into this, you want to choose an app that might help you with that, because stocks can be quite a bit of work for you to manage because you do need to be on top of it. Otherwise, you're going to lose money. As bluntly as I could say that. But that's what I have for you all today. And those are 4 highly encouraged apps. And I found that these were credible by Forbes. And so if you do trust that, go ahead and check those apps out. But that's all I have for you.
All right, so today I'll be talking about various emerging trends that are specifically in the tech sector, even more specifically like the information systems and the hardware sector. So the first trend is the systems on chips. There's a lot of very recent developments that have been going on there, and they've become faster and have developed capabilities of combining various computer components into custom chips, which makes data processing a lot faster. The rise of advanced RISC machines or ARM architecture for CPUs and advancements in graphic processing units and machine learning optimized chips have also allowed building efficient trading systems, the delivery of better performance and less complexity, and also overall has lowered the cost for various tech products. The systems on chips also combine separate components previously spread across a computer's motherboard, such as processors, graphics, processing units, memory, network, and input-output channels, into a single custom chip, which is usually the same size or smaller than the conventional CPU, which makes things a lot more efficient. Sorry. Many systems on chips deliver efficient performance partially because their CPUs use the advanced switch machine architecture, which runs a smaller, simpler instruction set. The second trend is edge cloud. So edge cloud is bringing greater scale, I'm so sorry, performance to consumers, and it reduces reliance on central processing. So enormous amount of data is being processed and consumed by many types of devices on the Internet of Things. And for those who don't know, the Internet of Things is a network of physical objects or things that are embedded with sensors, softwares, and other technologies for the purpose of connecting and like exchanging data. And so all of this is enabled by modern 5G networks. And Edge Cloud is specifically a dynamic and distributed cloud model, which computes and stores resources and helps move around various content. It also reduces reliance on centralized processing, which brings greater scale and performance to consumers. So the third trend that I'm going to be talking about is policies. There have been various policies that have been changed regarding consumer privacy. And so organizations can now share data and retain complete control over who can access and perform various analyses on data. And it can't really be leaked or accessed outside the bounds of what's permissible. So with federated learning, organizations can share insights without actually sharing data. Specifically, there's a concept called homomorphic encryption, and it's emerging in various technology sectors that allow organizations to share data, retain complete control over who can access or perform analyses, like I said, and own auditability of that process. However, data is still a source of competitive intelligence, so various financial institutions are naturally reluctant to share it. So there's a lot of homomorphic encryption companies that are gaining traction right now, and I'll go into that in a little bit. The fourth trend is SaaS in the cloud and infrastructure as code. All of that is also boosting efficiency and security. And various APIs give SaaS providers the flexibility and capability to innovate and improve the user experience. Clients pay per use nowadays in various SaaS in cloud services, and these clients have more agility in terms of managing costs, and they can potentially pass the savings on to their end users. Pricing is more granular as well. When clients purchase hardware for their data center, there's a 5 or 7 year depreciation. So how does this all relate to stocks? I got all of these tech trends from a NASDAQ PDF, which I'll send you guys the link. But more specifically, every time you find this kind of information, even though it might seem either very like specific and unrelated to what you're interested in, or just too complicated to understand, you can look at the various services that they're talking about, for example, the homomorphic encryption, and you can find companies related to that. So using your knowledge of ETFs, portfolio stocks, um, mutual funds, index funds, stuff like that, you can look into companies that are using, for example, the homomorphic encryption, such as Duality Technologies, Enveil, and Privitar, and invest in those. Also, another example would be like, as I previously talked about, Edge Cloud, which is becoming increasingly faster and helps process information faster. You can consider companies such as Clearblade, EdgeConneX, Dell, and Cisco. All of those companies will have their stocks probably be increasing because of these trends that are currently going on. And yeah, I'll send the link to the PDF, by the way, if any of you are interested, because there's a lot more information on there.
And then now moving on to retirement, there's, well, to start off, most of you have probably heard of this before, but there's a 401k. And this is a retirement savings account that allows like an employee when you work for a company to divert a portion of like your total salary into long-term investments. And oftentimes there's plans with your employer that will match your investments and stuff like that. So that's normally something to look out for in your various employment agreements. But moving on to the IRAs, an IRA is an individual retirement account, and there's two different types. So there's a Roth IRA and a traditional IRA. So the Roth IRA allows you to make after-tax contributions, and what you really want to look for when you're deciding which one is best for you is kind of your tax bracket. So for an example, for the Roth IRA, it's best suited for an individual who expects to be in a higher tax bracket when they start to take out money. So you should really reflect when you invest the money, where you think you'll be when you start to take out the money, which is normally around 60 years old in the retirement time. And then with a Roth IRA, you pay taxes on your contributions now, and then in the future, you get tax-free withdrawals. But the difference with a traditional IRA is it may allow you to make pre-tax contributions. So in this case, it's best suited for someone who expects to be in the same or lower tax bracket when they start to take out the money. So then you can just start deducting contributions now and pay taxes on withdrawals later. Something to keep in mind is that there is early deduction fees. Normally it's around 10%. If you withdraw the money before 59 and a half years of age, since it is saving for retirement. So that's something to keep in mind. And there's also various other fees based on which account you use. But some common accounts are Charles Schwab, the Vanguard Group, and Fidelity. And when I was researching some of these accounts, there's a lot of different rankings of where they rank, but some things that I found is with Fidelity, they have fewer fees. If that's what you're going for, it's one of the lowest cost options. But with Schwab, it's very well known for their extensive research, and for their IRAs, it was ranked #1 on a couple sources I saw, but they said it's all very close. So it's kind of just what's best for you. But with Schwab, they said that it was ranked #1 because of their comprehensive IRAs, and you have strong choices of where to invest because they have like a robo investor that can help you as well as financial advisors. So that's another thing with the IRAs. You can choose how you want to invest your money, if you want to invest into mutual funds or into stocks, or how you want to do that. And these accounts can help you choose what to do. So for an example, I have an Roth IRA or a traditional IRA through Charles Schwab that's invested into a mutual fund for like the future. So yeah, that's something to get started with. Most of these accounts are they don't have that much fees to get started, so that could be a great thing to start getting planned for your future because it's never too early to start saving for retirement.
Cool. So that's all that we had right now for personal investing. We were hoping to see if you guys had any questions. If you do, you can unmute yourself, or you can just type it in the chat and we'll answer it. All right. Well, no one has any. Does someone have a question?
No, I think the apps were helpful. That's what I was looking for, some for like my budgeting and stuff. So that was helpful.
Yeah, we got you, Evan. All right. Anything else? If
I
you
was
guys have
wondering if any of you all have personally invested in stocks or anything like that, and what your experience was if you've done that.
I can give my. So I started investing in 2018. I think you have to be 18 in order to start, or in order to get a investing portfolio. So yeah, and then I started kind of actively investing this year with the whole stock market being in the news. I made a lot of money, then I lost a lot of money. So I'm about even on that. So it depends which investments you choose. Typically, there are lower risk investments, and that can give you anywhere between if you invest in an ETF, it gives you anywhere between 10 to 15% a year, which is a lot better than just having your money in a bank, which is actually making your money decrease in value due to inflation.
Yeah, also I'm invested in a couple of ETFs and I've had a pretty positive experience with those as well. So if you're trying to start out with just investing in stocks, I'd recommend that.
Yeah, me as well. I have a Roth IRA and just kind of invested in ETFs. And if you're worried about monitoring your investments, that's kind of the way to go, because you can kind of just put it in there and not really touch it, and it's probably going to turn out fine. So if you don't want to have to monitor constantly, ETFs are the way to go. And definitely if you want it for retirement, look into Roth IRAs, because those are really good too, and they're not hard to set up.
I haven't invested much in individual stocks. I want to get into it, but right now I just have a mutual fund, and it's super easy to get started and super safe too. I've only had the money in there for 6 months probably, but it's already had a pretty good return on investment. So it just kind of just feels like a savings account that gets that grows pretty safely. I don't know, it's up a couple $100 on in 6 months, which is a lot better than it just sitting in a savings account. So I think that's a pretty safe one that I'm not really worried about losing the money, since it's such a big group of funds together.
If I'm not mistaken, if you file as independent, you actually get some tax deductions if you contribute to your Roth IRA. So that's another incentive to invest for the long term. Yeah. Hopefully that helps, Rachel. All right, cool.
Yeah, thank you guys.
Yeah, no problem. Oh, and then for I guess for platforms, I personally invest on E-Trade, but I'm sure other people have their own preferences in terms of platform. Very cool. Any other questions? All right. If there's no other if questions come up after the meeting, you guys can feel free to DM us on Instagram or email us, and we'll be happy to answer your question. But other than that, I think we are good for today. Thank you everyone for coming to our last meetings, I guess, for the quarter, and we hope to see you guys out there next year if you're not graduating, and if you're graduating, congratulations. See you guys.
See ya. Have a good day, everyone.
Yeah.